Hey traders, welcome to Charts and Coffee. Hope everyone is having a good Thursday morning. We've got some data hitting the charts. We've got some data hitting price action here this morning. And not it. I'll tell you one thing, it's really pretty funny. When you think about the way in which, let's go to the calendar here. When you look at the way in which GDP lands anymore, and I know this is preliminary GDP, but it's interesting how frankly unimportant in many ways GDP has become. And it's probably one of the major macro data releases, jobs, inflation, and growth. It's probably become really less than third important, frankly, because we've seen where the Federal Reserve has ignored GDP when it comes to a recession or any kind of economic slowdown. And so when I look at GDP here, I know it could be a market mover. It ticked up. If we were still in a bad news is bullish environment, that would possibly be a little bit of a reason to sell off. But frankly, GDP, if we're still sticking with bad news is bullish to stocks, take a look at the previous number at 1.6. And even though we expected lower at 1.2, this is still 0.3 lower than the previous. So maybe there is a good justification for continuing to move higher. So that's what I'm looking at there. Unemployment claims, this is really not even significant. Previous was 216,000. That was actually a revision. It was revised upward by 1,000. We expected 218, got 219. That's not really a huge market mover there. But nonetheless, we get two pretty big hot zones right there at 830. And we would know to just keep an eye on, based on the calendar, right? We would know just to keep an eye on price action. So what's the best way to deal with any kind of data release? And it doesn't matter to me if it's earnings. It doesn't matter to me if it's a Fed speaking event or even GDP and initial claims. Think of it this way. Do we really get that much insight into the numbers? Or is it just better for us to look at the response? And take a look at the 830 candle. We shot up. We're still clinging to a little bit of the range that we've been in. And in the free video yesterday, I mentioned the range on May 23 seems to have just sort of enveloped what we have seen so far this week, Tuesday, Wednesday, right here, Thursday. And ultimately, what I want to keep in mind is that we're really not, although we are a little bit lower pre-market today. All right, we are pre-market, and you could see the weakness that happened in the Asian session. Pre-market, we are a little bit weaker. But as we get closer and closer to 9:30, you start to see that, and even at 7 a.m., which we could consider to be that first cup of coffee in the U.S., volume increases, volatility increases at 7 a.m. So I kind of look at that as sort of a soft-ish, or at the beginning of the U.S. pre-market, so sort of a softish open. But once we get to 9:30, how many times have we seen that whatever happened in the pre-market is not what we see reflected in what's happening when we go forward, right? What's reflected when we go forward into the open, into those first 30 minutes, into that first hour. So I'll keep an eye on what's happened since GDP. We've taken about half of that back. And we'll go forward knowing that for the most part, we're clinging to that range. And it makes sense, right? When we think about the fact that we've got PCE tomorrow at 8:30, that's a far bigger economic hot zone than today's tag team of initial claims and GDP. That PCE is a direct look at what the Federal Reserve is using as their measuring stick for whether or not inflation is flat, cooling, still hot. So tomorrow's hot zone is definitely going to leave its mark on May. And that sentiment will likely carry into June, because that data alone will probably give us a lot more insight into what we're going to expect in September. All right. So with that being said, let's see. Let's take a look at whatever questions we might have. And copper. All right. Pat's asking about copper. Great question about looking at the futures contract. So one of the things that we do in the Sector Secrets Mastery is that we always want to see sort of, if you will, the root cause. There's a lot to be said about a hierarchy of the way a stock would move, or even a sector. So if I'm looking at copper, copper is one of the two canaries in a coal mine. meaning that when we see strength in copper and strength in crude, and we don't have strength in crude right now, but when we have strength in copper and we have strength in crude, that typically does reflect some kind of economic optimism from the strength in those two futures contracts. So when I look at copper, clearly we have an uptrend. And then when we step back and say, all right, Rod, can we buy dips in copper? I agree. Copper should be traded to the long side if you're looking at a longer time horizon, say 2 to 10 days at minimum. In other words, a longer term swing. I like to buy the dip, and we're seeing that right here in copper. When I then want to go to the next level down, all right, what does copper tell us more about? It tells us a whole lot more about the metals and mining sector. So if I look at XME, so copper's at the top of that food chain, then I go to XME. And when you take a look at XME, not just for the last month or so, but for the year, it's not been a gorgeous uptrend, but it's certainly more bullish than not. Still trading above the 200 propulsion, still plotting, at least in the last 2 months through April and now through May, mostly green candles. So we can see the strength of copper helping metals and mining. And then we go to where I have been probably most active in this whole area, which is strength in copper, overall strength of metals and mining. And then we take a look at what's happening in Freeport-McMoRan. Now, in Freeport-McMoRan, what's really interesting is that you can see this trend looks better than miners. This is a heavily weighted stock in the XME. And sometimes a single stock can look better than the group because some of the other stocks in that group may not be performing as well as FCX. So this continues to be, when we see dips in copper, I look at this as a proxy. So Pat, when I look at copper, that's that hierarchy. That's the mindset that I look at. And we can do this with anything. I mean, since we're talking about copper, let's talk also then about gold. They overlap in a rather unique way. Now, gold is not necessarily a metal of economic optimism, because think of the practical applications of copper. Gold, not really the practical application, but what is its role then in the way that we perceive its strength? It's a reflection of real yields, or also called real interest rates. In other words, what's the difference between the shorter end of the yield curve, the nominal yield of a bond, minus the rate of inflation? So when you do that arithmetic, you'll see that that number can go up or can go down. So if the nominal yield of a bond is going down and say inflation is flat or also going down, depending on the chasm between those two numbers, gold is going to move. So if inflation's cooling, I'm going to look for gold to head higher. If the nominal yield of a bond is flat or heading lower, I'll probably also still look for long positions in gold. So gold is not a flight to safety fear metal necessarily. It's absolutely going to move in many ways relating back to that real yield arithmetic. All right. So, and by the way, you don't have to do that arithmetic yourself. If you just go Google real yields or real interest rates, you'll find a number of sites that just put a chart out there, usually using a 1 or a 3-year bond minus the rate of inflation. So overall, do I want to be a buyer in gold? I do, but notice it's not as strong as copper. But if I go from gold to the next level down, let's go to GDX. So when I have clarity in the commodity, in that futures contract, then the next thing is which companies are going to benefit or move based on that strength or weakness. So mostly strength in gold, right? So I would look for mostly strength in gold miners. Now take a look at gold miners. They look better than gold. Now I don't want to trade gold miners to the long side if gold is heading lower, but gold's not heading lower. It's just sort of flat to bullish. Gold miners are in an uptrend. So if you're looking at a way to take advantage of gold miners might be the better way to do it. So that would be GDX. And then you have, say, a stock like NEM or Barrick Gold, Newmont Mining, Barrick Gold, GOLD. So these might be some other places to look for opportunity, but GDX is usually a very liquid option. So if you're looking for the open interest, if you're looking for the ability to trade a liquid, I call it tradable or scalable, right? In other words, there's enough open interest there where the spread is not cavernous. There's enough open interest where a smaller account trader could trade, say, 2 contracts, or a larger account could trade 22 contracts, right? Or more. So the scalability is very, very important. There are a lot of charts that look amazing. But then when you want to go take that idea to the option chain, you got to keep an eye on the strike that you're trading to make sure you're not wandering into an illiquid or widespread type trade, because that is risk, right? Getting in is one thing, getting out can be quite another. So GDX would be another great place to look, and then any of the heavily weighted stocks within it. For those of you that are just kind of getting used to this process of this top-down analysis, this sort of hierarchy of index sector stock, or what we just did here, which is commodity futures contract sector stock, check out the weekly watch list that I did this week in the I think it's posted in both the Simpler Central room, and I know it's in my Sector Secrets Mastery. I'm trying to think where else. It's in the main dashboard. Yeah, it's in the main dashboard. Yeah, check that out, because in a fairly succinct 10-minute video, I walk you through this process in a number of places that I'm looking right now. So super helpful as we go into June. All right, now what about crude? Let's say we do the same thing with crude oil. Start with crude. That's the top of the food chain, right? So the futures contract, then we'll take a look at the sector and stock. Now, crude's struggling. Yes, a lot of folks, unfortunately, probably got rope-a-doped to the long side in the crude oil contract. Here, oh, bear with me one moment, gang. I'm sorry. Give me one moment. All right, sorry about that, gang. All right, so if we are taking a look at, say, crude, and we'll do that same thing. The geopolitical surge that we saw here on the 28th, right? That was not a demand scenario. That was not OPEC cutting production, right? It wasn't any kind of supply of crude oil or demand of crude oil necessarily move. It was geopolitics and the concern that those things could happen. In other words, maybe some sort of reduced supply, but it wasn't a demand narrative. Anytime we're looking to buy crude, and we're looking again at economic optimism, number one, the chart should not be in a downtrend. So crude surged higher within the context of a downtrend, and it was a geopolitical narrative. So when you're starting to take a look at a big candle, and that's bigger than most of the candles average size that we saw, right? So it's something unusual. When it comes to crude, definitely take a look at the why, because crude is extremely sensitive to that geopolitical volatility. And ultimately, what we want to remember is that that is not necessarily sustainable. It certainly is not a trend. And so when crude does that, you'll see that XLE didn't care, right? XLE did not surge in any significant way at all, because the likes of Chevron, the likes of Exxon are not going to make significant shifts to R&D or investment or anything based on a very momentary move higher. So be careful with those. Crude remains really heavy. All right. Okay. So next up is XLU. All right. Utilities. Jazz, I love that you're asking about utilities, because one of the things that when we look at defensives, a lot of folks ask me, what's defensives, Rog? I'm not talking about aerospace and defense or ITA or PPA names. I'm not talking about those. What I'm talking about is a group of stocks that typically have within that group stocks that do have some good dividends, and stocks that are not necessarily heavily weighted in the NASDAQ, S&P, and Dow. So if the NASDAQ, S&P, and Dow are kind of off doing their own thing, or we're concerned about the overall movement in the broader averages, the defensives are sort of on the fringe, right? They're, of course, involved in the stock market, but in terms of their weighting, folks ask themselves and they say, well, no one's not going to need the power on, hence XLU, or my preference within the XLU as an individual stock, NEE, SO, DUK, D. These are all weighted heavily in XLU. So folks say, well, dividends, maybe. Do we need it no matter what, no matter what's happening with the economy? Yes. So things like staples and utilities are great places to be. Now, we have a long position going into today in staples. I would like to also re-engage utilities. I've been a little bit hesitant to do so because the equity markets are still flirting with those all-time highs. So it's not as if, the stock market is off in the corner of the room in the fetal position. So keep in mind, just because we aren't getting higher highs or just because we're stuck in a range for a handful of days doesn't mean that where we're, defying gravity and levitating isn't near those all-time highs. They are. So then you've got to ask yourself, how much upside? There might be some stability, but how much more upside could there be in staples and utilities? So I'm being a little bit more cautious about those because I'm not quite seeing, in terms of where the S&P or the NASDAQ are, that the market's necessarily afraid. It's just waiting, right? I mean, take a step back and do that. Say, okay, here's what's been happening since the beginning of the year. Is this fear? No, it's a little bit more of a wait and see. It's not as if we're printing even neutral candles. That's where the color coding of the candles is so helpful. It's not as if we're printing these yellow pause candles or even red fear candles. They're still green. We're just not seeing higher highs. And remember, most of the retail environment is going to buy anything at a higher high. Now, if you're listening to this show, you are not most of the retail environment, right? You are not your average in any way investor or trader. But think of your average newspaper reading, television watching, as if that's the research for trading and investing, type trader or investor. They're going to buy at higher highs because that's what's being talked about on television. Something's making a higher high and, I'm going to miss it. FOMO, YOLO, whatever. We call it FOMO, MOMO, BOZO in the Sector Secrets Mastery. So remember, when we don't see those higher highs, those folks positioned at 53.60, 53.70 are freaking out because, oh my gosh, I thought this was the beginning of more highs. And they sit with a small unrealized loss, and then they start to lose patience. So keep in mind where most participants are going to be positioned from on the retail side. So of course, things start to sound, oh my gosh, it's awful, and things are so scary because we're not punching the higher highs. Be careful of the typical chatter that's out there to that point. All right. Beef tallow. I do like to cook my eggs in a little bit of tallow. I will tell you that. All right. So Apple, we do have a long position in Apple. It is a buy the dip. We did that the other day when the green candles sunk into the price movement range, the PMR on the daily time frame. So I like the rally in Apple into the Worldwide Developers Conference at WWDC event. Typically, we see a little bit of strength as we go into that event. And XLK, as far as an individual sector, there are two strong sectors that are leading the charge to the upside. Both belong, for the most part, to the NASDAQ. SMH is number one. XLK is number two. So I like that Apple to the long side. All right. Pat's asking about the dollar and 6E. So as far as the dollar or the euro, and if you've been watching the show, Pat, thank you for the question on 6E. The best way to look at the dollar is to look at the euro, because 58% of the dollar basket, which is the DXY, which is DX futures, which is the UUP, is this thing, is the euro. So if I'm taking a look at the euro, it's sitting fairly nicely on the 200, which means it's sitting at support. It too is stuck in a range, waiting for a reason to rally as the dollar sinks. Now, remember, any central bank that's going to be either cutting or is in the midst of cutting will see a weaker currency. That is not a problem. It's by design. So lower rates weaken the currency, or rate cuts weaken the currency. So if there is weakness in the US dollar, the most unfiltered way to look at it is through strength in the 6E. And the 6E is green. The 6E is sitting above the 200. And if anything, it's just waiting for a reason. And that reason might be indeed tomorrow's PCE. All right, gang, as always, thank you so much for being here for Charts and Coffee. We are here Monday through Friday, 9 to 9:20. I've been doing this for the last 3 years. Thank you so much for being a coffee drinker and a fan of the markets. I'll see you tomorrow, same time, same station.